Most people open something from the IRS and feel their stomach drop. The assumption is always the same. Something is wrong, something is owed, something bad is about to happen. But there is another category of IRS correspondence that almost nobody expects, because almost nobody knows to look for it. The kind where the IRS is telling you they have money that belongs to you. The IRS has written into the tax code a set of specific provisions, credits, deductions, exclusions, and refund mechanisms that exist specifically for Americans over 65. The IRS is not required to tell you about any of them. The notice does not arrive on your 65th birthday. The tax software does not automatically find them all, and most general tax preparers, moving quickly through a routine return, skip at least one of them every single year. Today I'm walking through all 8, every major IRS provision that specifically benefits seniors and retirees, what it is, exactly what it's worth in real dollars, and precisely what you need to do to make sure you're using every single one of them. My name is Lucien Vane. I've spent years tracking the specific provisions of the tax code that change once you reach retirement age, studying how they interact with Social Security, Medicare, and retirement account rules, and specifically why so many qualified seniors end up paying more in taxes than the law requires. The answer is almost always the same, not because the provisions don't exist, because nobody explained them. That changes today. Before we go through the 8 provisions, I want to spend a few minutes explaining why so many seniors don't know about them. Because understanding why the information gap exists is part of understanding how to close it. Reason 1, the IRS is a collection agency. Its institutional function is to ensure taxes that are owed are paid. Its function is not to proactively help taxpayers identify every credit and deduction they qualify for. The IRS publishes instructions, and those instructions do describe these provisions, but the publications are hundreds of pages long, written in tax code language, and designed for reference rather than guidance. Reason 2, most tax preparation is volume-driven. A professional preparer handling dozens of returns during filing season has a strong financial incentive to process returns efficiently, which means asking the minimum questions needed to produce an accurate return, not the additional questions that might reveal credits or strategies the client hasn't already mentioned. This isn't malice. It's the structural reality of how tax preparation is practiced for most middle-income filers. Reason 3, tax software is designed for accuracy, not optimization. The major consumer tax software products are excellent at ensuring a return is mathematically correct and consistent with what you've entered. They are not designed to ask probing questions about your life circumstances to surface credits you haven't explicitly triggered. If the software doesn't ask and you don't know to answer, the provision goes unused. These 3 reasons together explain why a senior who is doing everything right, filing on time, using a preparer or software, paying what's owed, can still be leaving thousands of dollars on the table every single year through nothing more than not knowing specific things exist. Let's go through them. Provision number 1 is the one that should be impossible to miss, and yet, based on the number of amended returns filed every year to add it, a meaningful number of seniors either don't have it applied or have it applied in the wrong amount. It's the additional standard deduction for taxpayers age 65 and older. For 2025, every taxpayer who is 65 or older by December 31st of the tax year receives an additional standard deduction on top of the regular standard deduction. The amounts are as follows. $1,950 additional for a single filer age 65 or older, $1,550 additional per qualifying spouse for married filers, meaning a married couple where both spouses are 65 or older receives an additional $3,100 on top of the regular married filing jointly standard deduction, combined with the regular 2025 standard deduction of $15,000 for single filers and $30,000 for married filing jointly. A single filer who is 65 or older has a total standard deduction of $16,950. A married couple where both spouses are 65 or older has a total standard deduction of $33,100. Here's where it gets important to verify rather than assume. This additional deduction is supposed to be applied automatically by tax software when you correctly enter your date of birth, and by a preparer when they know your age. But errors happen. A wrong date of birth entry in software, a preparer who doesn't ask or who processes your return from last year's data without updating the age, or a situation where a spouse turned 65 partway through the year and the mid-year birthday wasn't accounted for, all of these can result in the additional deduction being missed. And here's what the failure to apply it costs. At a 22% marginal tax rate, a missed $3,100, additional deduction costs a married couple approximately $682 in unnecessary tax for that year alone. Over a 20-year retirement where this is missed every year, that's over $13,000 in overpaid taxes from a provision that takes exactly zero additional effort to claim as long as someone verifies it was applied. Action step. Pull out your most recent filed tax return. Find the standard deduction line, line 12 on Form 1040. If you are 65 or older, the number on that line should be higher than the base standard deduction for your filing status. If it matches the base standard deduction exactly and doesn't include the senior addition, file an amended return using Form 1040-X to correct it. Provision number 2 is one that most tax professionals don't bring up unless a client specifically asks about it, one that most tax software buries in a rarely visited section, and one that represents real, direct money back in a qualified senior's pocket, the credit for the elderly or disabled claimed on Schedule R. A credit is different from a deduction. A deduction reduces your taxable income, so its value depends on your tax rate. A credit reduces your actual tax bill dollar for dollar. The credit for the elderly or disabled reduces your tax liability directly, which makes it more valuable, dollar for dollar, than an equivalent deduction. Here's who qualifies. You generally qualify for Schedule R if you are 65 or older by the end of the tax year. Age-based qualification, no disability required for seniors. If you are under 65, you can also qualify if you are permanently and totally disabled and receive taxable disability income during the year. Now here's where the income limits come in, and this is where many middle-income seniors incorrectly assume they don't qualify. The credit begins to phase out at modified adjusted gross income above $7,500 for single filers and $10,000 for married filing jointly. For many seniors, particularly those whose income comes primarily from Social Security and small pension or IRA distributions, these thresholds are low enough that the credit is reduced significantly or eliminated by MAGI. But, and this is the part most people miss, the MAGI calculation for this credit excludes certain income that most people would assume counts. Specifically, the non-taxable portion of Social Security income is not counted in the MAGI for this credit, which means seniors whose gross income includes significant Social Security may have a lower qualifying MAGI than they expect. The maximum credit amount ranges from $3,750 for single filers to $7,500 for married filing jointly before the phase-out calculation. For most seniors in the qualifying income range, the actual credit after the phase-out is several $100s. That's several $100 directly off your tax bill, not your taxable income, your actual tax liability. Here's exactly why this credit goes unclaimed so consistently. It lives on a separate schedule, Schedule R, that has to be attached to your return. Tax software typically requires you to specifically navigate to this credit and answer its qualifying questions. If you don't know it exists and navigate to it directly, it's easy to complete an entire return without ever being asked about Schedule R eligibility. If you used a tax preparer, ask them directly, "Did you check my eligibility for the credit for the elderly or disabled on Schedule R?" If you use software, search specifically for Schedule R or credit for elderly or disabled in the software search bar and answer the eligibility questions directly. And if you've been eligible for this credit in prior years and it wasn't applied, you have up to 3 years from the original filing deadline to amend those returns and claim the credit retroactively using Form 1040-X. Action step. If your adjusted gross income is below approximately $17,500 for single filers or $20,000 for married filing jointly, the approximate thresholds where the credit completely phases out, specifically check whether Schedule R was attached to your return. If it wasn't and you're 65 or older, file an amended return for any qualifying prior year within the 3-year window. Provision number 3 doesn't involve a single form. It's a set of 3 legal strategies that reduce the percentage of your Social Security income that is subject to federal income tax. And for many retirees, Social Security taxation is the single largest, most preventable tax bill they pay each year. First, let me establish the foundation. Social Security benefits are taxed based on what the IRS calls your combined income, which is your adjusted gross income, plus any tax-exempt interest, plus half of your Social Security benefits. Based on where your combined income falls, Between 0 and 85% of your Social Security benefit becomes taxable income. Here's the strategic insight. Because the percentage of Social Security that's taxed is determined by your combined income, anything that legally reduces your combined income reduces the percentage of Social Security subject to tax. 3 strategies accomplish this directly. Strategy 1. Roth conversions during low-income years. Money withdrawn from a Roth IRA is not counted in adjusted gross income and therefore doesn't enter the combined income calculation. If you converted traditional IRA funds to a Roth in a lower income year, or do so strategically in years when your income is particularly low, future Roth withdrawals reduce your combined income relative to taking equivalent traditional IRA withdrawals, which do count. Strategy 2. Qualified charitable distributions, which we'll cover in detail as its own provision shortly, but which is worth mentioning here because it reduces your adjusted gross income directly. If you're 70 and a half or older, a QCD reduces your AGI by the amount of the distribution, which directly reduces your combined income, which directly reduces the percentage of Social Security subject to tax. Strategy 3. Timing of IRA withdrawals. If you have flexibility in when you take IRA distributions, specifically if you're not yet required to take RMDs, taking distributions in years when your other income is lower keeps your combined income lower, which keeps the Social Security taxable percentage lower. This is sometimes called income smoothing, and for retirees with significant traditional IRA balances, the cumulative tax savings from smoothing can be substantial. Here's the dollar impact of getting this right. A married couple with $40,000 in Social Security and $30,000 in other income has combined income of $50,000, which puts up to 85% of their Social Security in the taxable tier. At a 22% tax rate, that's up to $7,480 in taxes on Social Security alone. If a QCD strategy or Roth conversion strategy keeps their combined income below $44,000, the taxable percentage drops to 50%, and the tax on Social Security drops to up to $4,400, a difference of over $3,000 per year from income management alone. Action step. Calculate your combined income for last year, your AGI plus tax-exempt interest plus half of your Social Security. Identify which tier you're in. If you're in the 85% tier and close to the 50% threshold, speak with a tax advisor specifically about whether a QCD, Roth conversion, or IRA withdrawal timing strategy could reduce your combined income and therefore your tax bill on Social Security. Provision number 4 is one that more seniors know about than most on this list, but far fewer actually use correctly because the threshold question trips people up before they ever get to the calculation. It's the medical expense deduction. Medical expenses that exceed 7.5% of your adjusted gross income are deductible on Schedule A as an itemized deduction. This threshold applies to all taxpayers, regardless of age. And the first question most people ask is, do I have enough medical expenses to exceed 7.5% of my income? Here's where most people stop and where they make a mistake. They think of medical expenses as only the bills they paid at the doctor's office. The IRS definition of qualifying medical expenses is far broader than most people realize, and for a retiree with common age-related expenses, the list of qualifying costs is often much longer than expected. Let me focus on a few of these specifically because they are consistently undercounted. Medicare premiums, your Part B premium, your Part D premium, and any Medigap supplemental premiums are qualifying medical expenses. For a married couple, each paying $185 per month in Part B premiums, plus a Medigap premium of $200 per month each, plus Part D premiums, their qualifying Medicare-related expenses alone are approximately $7,000 to $9,000 per year before any actual medical bills are counted. Long-term care insurance premiums are also deductible, with age-based limits set by the IRS. For 2025, a taxpayer age 71 or older can deduct up to $5,880 in long-term care insurance premiums per person as a medical expense. That alone, combined with Medicare premiums, can push a senior couple's qualifying medical expenses well above the 7.5% threshold on a modest retirement income. Action step. Before you conclude that you don't have enough medical expenses to itemize, make a complete list of every qualifying expense, including Medicare premiums, Medigap premiums, Part D premiums, long-term care premiums, dental, vision, hearing, and prescription costs. Total them up, calculate 7.5% of your AGI, and see whether the excess is large enough to itemize. For many seniors with premium costs alone, the answer may surprise you. Provision number 5 is one of the most powerful tools in the retirement tax toolkit and one of the least widely understood. It's called the Qualified Charitable Distribution, or QCD, and it is specifically available to IRA owners who are 70 and a half or older. Here's how it works. If you're 70 and a half or older and you have a traditional IRA, you can direct your IRA custodian to transfer money directly from your IRA to a qualifying charitable organization, up to $105,000 per year in 2025. That amount counts toward your required minimum distribution for the year. And here's the critical tax feature: that transfer never appears in your adjusted gross income. It goes from your IRA directly to the charity, bypassing your income entirely. Compare this to the normal charitable giving process. You take an IRA distribution, it appears in your AGI, you pay income tax on it, and then you donate the after-tax amount to charity and take a charitable deduction if you itemize. For someone who doesn't itemize, which is the majority of taxpayers after the 2017 standard deduction increase, you never even get the deduction, so you're paying income tax on money you gave away. The QCD is almost always more tax efficient than the normal giving process for IRA owners over 70 and a half because it eliminates the income recognition entirely regardless of whether you itemize. And the reduction in AGI from a QCD reduces your combined income for Social Security taxation purposes, potentially reducing the percentage of your Social Security that's taxable, the cascading effect we discussed in the previous provision. Here's the specific dollar example. A retired couple with $35,000 in SS income and $30,000 in IRA RMDs has combined income of $47,500 in the 85% SS taxable tier. They also donate $5,000 per year to their church. If they do that donation as a QCD instead of a regular donation, their AGI drops from $30,000 to $25,000. Their combined income drops from $47,500 to $42,500 into the 50% SS taxable tier. That tier change alone can reduce their tax bill by $1,000 to $1,500 from a choice about how to give money they were already giving. Action step. If you are 70 and a half or older, have a traditional IRA, and make any charitable contributions during the year, contact your IRA custodian and ask specifically how to set up a qualified charitable distribution. The process is straightforward. The custodian sends the check directly to the charity, but it must be done correctly to qualify. A check made payable to you and then donated does not qualify. Provision number 6 is the one that produces the most disbelief when people first hear it, because most people assume capital gains are always taxed. For a large percentage of retired households, they're not. The 0% long-term capital gains rate. Long-term capital gains, meaning gains on investments held for more than 1 year, are taxed at preferential rates, 0%, 15%, or 20%, depending on your taxable income, not your gross income. Your taxable income, after your standard deduction, after your senior additional deduction, after any other deductions you're entitled to. For 2025, a single filer with taxable income up to $47,025 pays 0% in federal capital gains tax on long-term gains. A married couple pays 0% on taxable income up to $94,050. Here's why this is so meaningful specifically for retirees. A married couple whose gross income consists primarily of Social Security and modest IRA distributions may have a taxable income. After the married standard deduction of $30,000 and the senior additional deduction of $3,100, total $33,100, that is well below $94,050, even with a combined gross income in the $60,000 to $80,000 range. This means such a couple could sell appreciated investments, stocks, mutual funds, real estate outside their primary home, and realize tens of thousands of dollars in long-term capital gains, and pay 0 federal capital gains tax, as long as the gains don't push their taxable income above the $94,050 threshold. This is not a loophole. This is the law. Congress intentionally created preferential capital gains rates, and the 0% tier exists specifically to ensure that lower and moderate income taxpayers, including retirees, are not taxed on investment gains at the same rate as high-income earners. The practical application requires planning in advance. Before selling any appreciated investment, calculate your projected taxable income for that year. including all income sources minus your applicable deductions, and determine how much room you have within the 0% threshold. If you have room, consider harvesting gains up to that amount. If a large distribution or other income event is also planned for that year, coordinate the timing to avoid pushing taxable income above the threshold. Action step: if you have appreciated investments in a taxable brokerage account, calculate your projected 2025 taxable income. If it's below $94,050 for married filing jointly or $47,025 for single filers, you may have room to realize long-term capital gains at 0% federal tax. This is one of the most valuable tax planning opportunities available to retired households, and it requires knowing your taxable income number before you sell, not after. Provision number 7 is the one with the hardest, most unforgiving deadline of everything on this list, and it's the one where inaction permanently costs you money that you're legally owed. It's the 3-year window to claim a prior year tax refund. If you are owed a refund for a given tax year, whether because you overpaid through withholding, because you qualify for a credit that wasn't claimed, or because a deduction was missed, you generally have 3 years from the original filing deadline for that year to claim it. After 3 years, the refund is permanently forfeited to the U.S. Treasury. There are almost no exceptions. Here's who this specifically affects among senior taxpayers. Seniors who had a year of low income, perhaps early in retirement, where they had federal tax withheld from an IRA distribution, a pension, or part-time work, but whose total income was low enough that they weren't required to file a return. They didn't file because they didn't legally have to, but they were owed a refund for the withheld tax, and if they didn't file a return to claim it, it sat at the IRS waiting for 3 years and then was forfeited. The same 3-year window applies to amended returns claiming a refund, including returns you might file to add a Schedule R credit, a missed medical expense deduction, or any other provision you discover you should have claimed in a prior year. If 3 years have passed since the original filing deadline for that year, the amended return can be filed, but no refund will be issued for the corrected amount. Action step: look at the last 3 tax years. For any year where you had federal tax withheld from an IRA, a pension, part-time work, or any other source, and did not file a return, file that return now before the window closes. For any year where you believe a credit or deduction was missed, check whether the 3-year window is still open and file Form 1040-X for any year that qualifies. Provision number 8 is not a tax provision in the traditional sense. It's a resource that ensures all the provisions we've covered today are actually applied correctly to your return, at no cost to you. It's free, certified tax preparation specifically designed for seniors. 2 programs provide this. The first is VITA, Volunteer Income Tax Assistance, an IRS program staffed by IRS-certified volunteers that provides free tax preparation for taxpayers who generally earn $67,000 or less. VITA sites are located at libraries, community centers, and senior centers nationwide and are open from late January through April 15th. The second is AARP Tax Aid, specifically designed for taxpayers 50 and older, available to anyone regardless of income, staffed by AARP-trained and IRS-certified volunteers, and available at thousands of locations nationally. Here's why I'm including free tax preparation as a provision in this video rather than just a footnote. The volunteers at VITA and AARP Tax Aid are specifically trained on the provisions most relevant to seniors, including Schedule R, the Senior Standard Deduction, medical expense calculations, QCD reporting, and prior year refund opportunities. In many cases, they will identify something a paid general preparer missed. Action step: if you are currently paying a tax preparer and your income is below $67,000, or if you're 50 or older at any income level, find your nearest VITA or AARP tax aid site at irs.gov/VITA or aarp.org/taxaid before your next filing. The savings on preparation fees alone can add up over a multi-year retirement, and the quality of senior-specific expertise at these programs is often higher than what a general preparer provides. Before the final checklist, one more specific action worth taking: checking directly whether the IRS is currently holding a refund for you from a prior year. Go to irs.gov and create or log into your IRS online account. This free account shows your filing history, any refunds issued or pending, and your tax records for the current and prior years. You can also request a wage and income transcript, which shows all income reported to the IRS under your Social Security number for a given year, including any years where you had withholding but may not have filed a return. If you see a year with significant withholding and no corresponding filed return in your account, that's the signal to file that return immediately, while the 3-year window may still be open. Here's your complete action checklist. 1. Pull out your most recent tax return and verify the senior additional standard deduction was applied correctly. Single filer 65 plus, $16,950 total. Married both 65 plus, $33,100 total. 2. Check specifically whether Schedule R was attached. If you're 65 or older with adjusted gross income below approximately $17,500 single or $20,000 married, and Schedule R wasn't filed, file Form 1040-X for each qualifying prior year within the 3-year window. 3. Calculate your combined income and identify whether you're in the 0%, 50%, or 85% Social Security taxable tier. If you're in the 85% tier and close to the 50% threshold, speak to a tax advisor about QCD, Roth conversion, or withdrawal timing strategies. 4. Make a complete list of every qualifying medical expense, Medicare premiums, Medigap, Part D, long-term care insurance, dental, vision, hearing, prescriptions, transportation. Total it and compare to 7.5% of your AGI. 5. If you are 70 and a half or older with a traditional IRA and you make any charitable contributions, contact your IRA custodian this week about setting up qualified charitable distributions for this year. 6. Before selling any appreciated investment in a taxable account, calculate your projected taxable income for the year and determine whether you have room in the 0% capital gains tier. 7. Check the last 3 years for any year with federal tax withholding where no return was filed. File those returns immediately. 8. Find your nearest VITA or AARP tax aid location before next filing season. irs.gov/VITA or aarp.org/taxaid. The IRS does not owe you money because of a mistake, a special status, or a loophole. It owes you money because of provisions written into the tax code specifically for people in your situation, and the only thing that determines whether that money reaches you or stays at the Treasury is whether you know the provisions exist and take the specific steps to claim them. Every provision in this video is available to you right now. Every form mentioned is free. Every action step can be started this week. If this video helped you, subscribe. Every week I cover the IRS rules, Social Security strategies, and Medicare rights that make a real difference in what a retired household actually keeps, not just what it earns. Share this with every senior you know who is filing the same return the same way they have been for years without ever asking whether they're using every provision they're entitled to. That share might be worth thousands of dollars to them. I'll see you in the next one.